Hello and welcome to this special episode from Weekend Investing. As you know, we do special data-backed episodes to bring out the analytics of investor behavior and how you can improve your investing journey using these case studies. So today's case study is all about should you or can you simply buy and hold forever in today's world? And we will take some examples. These examples are not meant to have any bias against these particular stocks or sectors. These are just examples because they highlight the issues that we are trying to address. So the example that we're going to take today is that of ITC, and we will take the case of how ITC has performed in various parts of its journey to bring out the case that we are seeing. So overall, over last 30 years, is CAGR of 17.6% post dividend, which is a fantastic performance by any metrics for any stock in the market. This is simply phenomenal. However, uh, when we compare it to Nifty, you will see the outperformance in a manner where has done maybe like 2000% and ITC is up something like 11,000% in the last 30 years. It looks awesome. Everything is fine, but there are periods where it can really frustrate you to hell. And for almost 8 years, for instance, in 2000, approximately 13 to 21, ITC didn't go anywhere from point to point. There was another period in 1999 till 2003 for about 4 years. ITC didn't go anywhere, and another one yet again 2006 to 2009-10 that didn't work so well for this company. Now, while you may say that it's okay to wait for a few years because overall the performance is great, but you also must keep in mind that no corporate globally is immune to competition, is immune to market share being taken away by other companies, is immune to changing preferences of people. Technology changes, all kinds of efficiency or inefficiency in a company can potentially not have the stock repeat what it has done in the last many decades. And this is no prognosis for this particular company, just to clarify again. So the point is that you can't rely on 6, 7, 8, 10 year kind of periods to figure out whether the stock is moving in your direction or not. There are several other examples I can quote. One comes to my mind is that of Alibaba, where the last 9 or 10 years has resulted in a zero return for its investors, while the whole world has moved in a different path. Now let's see what happened during this phase of consolidation. We will focus on this 2013 to 2021 period. There was one spurt in the middle towards 2017-18, and then there was one very sharp dip towards 2020. But if somebody was, let's say, bought after seeing this run, had to wait about 8 years for that run to continue again. So comparing it with its own industry benchmark, CNX FMCG and Nifty 50, you'll be surprised with many of these data points. So ITC, while it was flat for this period, 1.5% up, FMCG sector in the same time period moved up 89%, and Nifty in the same time period moved up 160%, while this particular stock remained stagnant. ITC versus other popular FMCG stocks in that same period, you can see the stock of Britannia 966% in the same time period, Marico 453%, Hindustan Lever 322%, 258% on Nestle, 256% on Godrej CP, and of course Nifty 166 and FMCG 93% for reference. This is the kind of opportunity that existed during those 8 years. Even if you got some part of that opportunity, you still have that opportunity locked in, and you can always come back to the stock. So the mindset of the investor who's watching is that stock underperforms its own benchmark for 8 long years, and some other stocks from the same sector are going up multifold. So what should one do? So one gets very invested mentally into a story, and it's like a deer in the headlight syndrome, where you don't want to exit, but you are also seeing other stocks doing well, and you want to buy them, but you also don't want to give this up. So you can't sort of have the cake and eat it too. So in the same time period, for instance, uh, other sectors were also performing very well. So IT sector during this period performed 372%, financial services 236%, banks 196%, metals 188%, consumption stocks 163%, commodities 150, energy 136, autos 120. So you can see that there were nine other sectors which performed better than even the FMCG sector, which still was doing very well at 113%. And of course, there were other sectors that did not do as well as FMCG, but 16 sectors did better than the particular stock that we're talking about. Now, the question to be asked is, what is the opportunity cost of sitting in a stock for 8 years? And while right now, with hindsight, we can say post that 8 year period, we did get a move up, and hence it was worth waiting. Had it not moved up, what would be the situation today, right? It the case for a lot of stocks like I mentioned Alibaba, for instance, or even Reliance and Levers have gone through periods of consolidation of 8, 10 years. There have been cases with companies like Eban Lloyd, for instance, or Suzlon, or uh, so many other cases where just there's a whole change of focus from the market towards that stock. It could be Vodafone, it could be anything. Uh, so why not have exposure to other sectors? For instance, somebody sitting concentrated in one stock. Why not have exposure to other sectors which are doing well? Why not have exposure to other stocks that are doing well in the same sector if you have to? So essentially, lot of opportunity cost gets lost in 8 years. Uh, of course, with hindsight benefit, you can say that you could have gone to other sectors, made money there, and come back and bought your favorite stock in case you had to. But not having exposure to other sectors, not having exposure to other stocks in the same sector can cost you very, very dearly in terms of performance if this stock does not perform. Because 8 years, 10 years, that has been the case with many stocks, is a very, very long time, right? And a lot of times your patience gives up. You think that you can wait 10 years, but maybe after 3 years, when you see everybody around you is making, 20, 30, 40% kind of returns every year, you become maybe a bit edgy and you want to give it up. And usually what will happen is the stock will bottom, or the stock will start when most of the people who had confidence will give up, and that's when the new leg may start. That is usually the case. So here's where confirmation bias also kicks in. When you are invested so deeply into one stock, every news that is positive about the stock, so you will try to select every news that is positive about the stock and say that yes, yes, my decision is right. The company is doing well in this particular area. This product is doing well in this area. Any news that tends to you know have a conflict with your thought process, you will ignore it. This is human psychology. I mean, it's not about you or me. Everybody will go through this. So you tend to select. I mean, even when you are looking at an ad of a product of that company, you will feel good that yes, I have this company, the ad is looking good, this stock will do well. So that's how you're trying to confirm to yourself that. Then you will also seek other investors, क्या करना चाहिए, and a group forms where everybody massages each other's confidence and says yes, yes, we should stay together, and it's just a matter of time before the stock comes back again. And sometimes it happens, sometimes it doesn't, right? So like-minded people will reconfirm your bias. And despite noticing the significant growth in the other sectors, you tend to dismiss those them as that maybe it's just temporary. uh, Eventually we will catch up. This cannot be right. This is something, this just a fleeting thing that is happening. So you convince yourself that yes, what I'm doing is right. And just like when somebody buys a house, you and you bought it, and now you're seeing some other new development, some other new house coming up, some other new complex. You tend to look at the positives of your own thing and say, no, no, this is the best. I took the best decision. even though that may be cheaper, better, but still you will try to convince yourself somehow. And that's how human psychology works. And you also will try to rationalize whatever is lacking. Just in this case, for instance, the stagnation is attributing to temporary market factors, claiming it's stable long-term hold rather than missed opportunities elsewhere. So you tend to rationalize your thoughts. Now, the way momentum approaches stocks or situations like this is to be completely, unattached to any thought process of, you know, uh, having any bias towards any stock. So in this entire journey, there were several pockets of momentum that were there, in 95 to 99, then 2003 to 2007, then 2012 to 16, 17, and then 2021 till currently on. And you could have participated in several of them. Of course, by participating piecemeal in several of these, you would not have made as much money as somebody who would have held on for those 30 years, but then you would have probably made much more money in the periods of consolidation or periods of your opportunity cost at other places. And the second part is that you would not be bothered about the stock as such. You would be only be bothered about your process, that yes, I'm following my process, and whatever stocks are coming to me in momentum, I'll be buying them and I'll exit them when the time comes. So totally ignored uh, the stock during this consolidation, the momentum strategies. And one of our momentum portfolios entered this once it broke out here at 253, and we booked a gain also here at about 68%. And this last leg is not uh, there in any of our portfolios. So in any case, this is how small portions of the gains can get captured without getting uh, fixated with one stock. So some may argue that stock is trending up again and it's up 30% from recent bottom, but that's okay. I mean, you can't have, as they say, you can't be at all the parties in the town. So this is how a very agnostic approach, uh, helps you not have any stress, any anxiety, any biases. You have complete peace of mind, potentially also more returns, because you are not fixated to one sector, one stock, few stocks, few sectors. You're saying whatever is moving, I want to be a part of that. So this is a brief about how a lot of, and why this timing of this particular study is there, because I think in the coming years there will be a lot of angst with a lot of buy and hold. uh, Markets have run up, but particular sections of the market have run up quite a bit. uh, Sooner or later there will come a time where long holding periods will be required if you wanted to make money out of your position. And these kind of contents will help you rethink your strategy as to how you should think about long term buy and hold. And if there's any alternate available to you, do you want to consider that? And even if you did the buy and hold, you should be ready for the long haul, and make sure that your companies that you are invested in will take you beyond that long haul to see you through. But if you just wanted a very easy, peaceful way of dealing with the markets, momentum is there to serve you. Thanks. Bye.